Bitcoin breaks down below 108,000 as the repo market continues to stress. The Blue Jays lose. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's episode, we're going to hit the repo market and look at Bitcoin's price. Let's start there. Here we have the weekly candles on Bitcoin. You can see here that the orange trend line and the green trend line, which are our supporting trend lines here in the bull market, those are the two areas that the Bitcoin price must hold. Those are the areas I'm watching most closely. Now, let's take a look at these two horizontal lines at 108,442 and 111,905. These two lines, while those dollar amounts are not exact areas that we need to focus on, the general area of this 108 and 112 has been a congestion zone for Bitcoin for all of 2025. It's the area we reached at the beginning of the year. We touched the 112 area during the summer, came back and consolidated around that with another pop up to an all-time high later in the summer, but then Bitcoin now falling back below 108,000. The green trend line has been in place since the October 2023 court case in which Grayscale defeated the SEC. That was the green light for Bitcoin ETFs. So that green trend line is very important and essential for Bitcoin to hold in this bull market. The orange supporting trend line here is a trend line that connects the 2024 summer low to the 2025 Liberation Day area when Bitcoin fell below 80,000. And it gave up some or many of its post-election gains. So those are the two trend lines that are most important. Right now, if I were to draw them, those support levels would be at around 96,000 and 87,000. So in the 87 to 96,000 area, we have a massive amount of trend line support. Now, trend line support only means something if buyers step in and buy there. So this is not a price prediction. And remember, technical analysis is not used to predict price. It's used to manage risk, and it's used to understand the behavior of the market. So the answer to the question, are we still in a Bitcoin bull market, will be answered at 95, 96, and at 87. If those levels hold and Bitcoin bounces and we get support acting as support, then you can say the bull market is intact. Until then, it's too early to say. And the only thing that we know is that Bitcoin has given up this 108 to 112 area. So we can expect the market to try to find that next area of support. I'm not going to say that 100 won't be a good test for Bitcoin, but technically 100K is more of a round number than something that the chart is telling me on a technical basis. One more chart with candles on here. I just noticed going through my monitor that the dollar has broken out above this 99.5 level, which had served as a resistance for the last several months. That was the local high. Over the last two candles, the dollar is breaking out to the upside. This is on the margin bearish for TBL liquidity in the way that we calculate it. It's also a condition that will be restrictive on risk markets. While the stock market is still trading right near all-time highs and having a good day here on Monday, November 3rd, Bitcoin is not. And we believe that Bitcoin's underlying weakness, while there's been weakness in the trend, the main cause for Bitcoin's weakness over the last few weeks has been the strength of the dollar and the popping up of the dollar really beyond this level of consolidation. So when we look at this chart here, I have the daily candles for you. The blue line is 99.5. That has acted as a resistance. The dollar, remember, the dollar had a terrible year in terms of the administration moving toward a weak dollar policy, but that has reversed a little bit here over the last couple months, and now we see the dollar popping up toward the 100 level on DXY. So let's continue to watch that. This is a very important macro factor. All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio, and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app, and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com, use code TBL for 10% off. Also remember that we have tightness in funding. There's a repo market situation that we must be cognizant of. We also have a government shutdown, which means that you have money moving around the Fed's balance sheet from the reserve portion to the Treasury's general account. The government trying to make sure that it has enough money to fund its operations over the coming quarters, rebuilding that Treasury general account that sucks money out of the rest of the financial system. It can be a liquidity negative metric. Now, from the way we measure liquidity at TBL, we are looking at an asset-based model. Remember that the Treasury general account and the reverse repo facility, these are liability line items on the Fed's balance sheet. So while there are analysts that are going to talk about Fed liquidity, what they are talking about is the quantity of money in the system that the Fed has dedicated to the private sector and dedicated to the U.S. government. As the U.S. government portion increases, that is a draw on the private sector, and that's when you hear negative Fed liquidity. It means the Treasury general account is growing and the amount of reserves in the system are shrinking. Also note that the RRP, the reverse repo facility, is no longer a relevant line item on the Fed's balance sheet, so not contributing to the Fed liquidity analysis. But we don't cite Fed liquidity specifically because we want to build a framework around TBL liquidity. It's an asset-based model. It uses the dollar, the stock of global banking assets, not liabilities, the Treasury market prices, so the strength of collateral, and the volatility of that collateral captured by the MOVE index. If you're interested in our proprietary liquidity metric and the indicators that we are deriving based on that metric and its correlations with the stock market and Bitcoin, thebitcoinlayer.com/subscribe to become a TBL Pro today. Hopping into repo right away, let's bring up the SOFR to IORB spread and compare that to the Treasury General account, which we had just mentioned. Now, a special thank you to Lynn Alden, an excellent global macroeconomic analyst and the author of a fantastic book called Broken Money, which breaks down a long history of money from commodity type money to credit money to the modern financial system to Bitcoin and decentralized money. It's an excellent book, really of encyclopedic level knowledge that Lynn delivers there. But enough about Broken Money. We thank Lynn for pointing our attention to the TGA build contributing to repo market tightness. So on this chart, we have the spread of SOFR to the interest on reserve balances. That's a spread we've covered in every single show for the past couple weeks. It blew out on October 31st. That was a month end, a year end for Canada. There was a settlement of Treasury securities, so a large movement in cash in the system. It spiked repo rates out 32 basis points above interest on excess reserves. That's 22 basis points above the ceiling. So a 4.22 SOFR is 22 basis points above some of the Fed's emergency repo and discount rate lending facilities. What does this SOFR spread mean? It means there's a tightness in funding. Funding is a word we use to describe the repo market because that's what's going on. You have dealer balance sheets with a lot of Treasury inventory, and they don't have the money for that inventory, so they have to source it. That is why it's called funding. The dealer funds its balance sheet inventory with capital from the repo market. Notably, these are money market funds that are the main contributors to the repo market. Money market funds put their capital into the dealer on an overnight basis, only securing interest for one day. They are not participating in the economics of the Treasury trade. That is done at the dealer level. The dealer is struggling to finance his or her inventory right now. That's the story that the SOFR to IORB spread is telling us. Why is the dealer struggling to fund? There's two sides to that equation. Number one, the quantity of inventory, and number two, the quantity of repo cash available to the market. So if there is a ton of collateral to fund, that by itself is going to create tightness in funding because you only have a certain amount of cash that's ready to give to the dealers every night. But if the dealers have more inventory than they're used to having to fund, that's where the tightness comes from. The Treasury Department is issuing a ton of securities, a ton of Treasury bills, Treasury notes all across the curve. Those treasuries end up at a dealer. The dealer has to find overnight cash until the dealer finds the ultimate holder, the hand of that security, until the dealer ultimately finds the long-term holder of that security. And that process is bridged through the repo market. The repo market is tight, and the SOFR to IORB spread blowing out has occurred alongside a build in TGA. So what happens when TGA grows and the repo market gets tight? What is the mechanism that causes that? You can see here, Treasury General Account approaching $1 trillion. That build has been going on since the summer, and repo rates have climbed, the spreads have climbed over that time horizon. So what is the mechanism? Let's take a look at this next chart to give us a little insight on why that happens. This is the chart of Fed Reserve liabilities. So the orange portion and the red portion are what we have to focus on. The orange plus red are a zero-sum game in the system. Green, I know you still have a little bit of repo line item. That's a foreign repo line item. That's not what we're talking about here. The red and the orange portion here are zero-sum. It means when the TGA builds, you see the red portion growing over the last several months. The orange portion shrinks. It is a mathematical trade-off there that the Treasury, the only way the Treasury gets funded are from reserves from the Fed's balance sheet settling into the Treasury General Account out of reserves, previously out of reverse repo. Those were the sources of cash to fund the Treasury account. So if reserves are shrinking, the orange portion is shrinking. Remember our Jamie Dimon, JP Morgan Fortress balance sheet. A big portion of the orange is JP Morgan itself. So as the orange portion shrinks, the availability of funds for the repo market. Now, that's the other side of the equation. We talked about quantity of collateral. What about the quantity of funds to fund the repo market? Some of those funds are in reserves, and as reserves decline, when TGA increases, that contributes to scarcity of reserves, scarcity of funding available in the repo market. And that is the reason that Lynn Alden pointed us to this information. TGA building, repo market rates climbing. She cited a similar dynamic in 2019 when we had the September 2019 repo crisis. Now, are we looking at a repo crisis right now? No, but the funding tightness is still there. A crisis it happens incredibly quickly. When the repo market can't fund itself going into 2 p.m. and 3 p.m., it's a crisis. When it gets funded but at a high rate, that's stress. So the line is very thin, and the Fed knows that they have to stop a crisis before it happens. That's why you have standing repo facility usage. Here we bring up the standing repo facility usage. This is a daily facility. The market comes to the Fed and says, hey, I can't find funding for my collateral. Will you fund me? Here's the collateral. And you can see that this number has come off of zero. There's a funding tightness in that certain dealers have to go to the Fed directly. The SOFR market is measuring transactions in the market that are between bilateral parties that go through a tri-party agent. They're looking at that money market to dealer funding transaction. That's what the SOFR yield is looking at. It's looking at the market rate for repo. But if that rate is high, it's going to motivate a dealer to go to the Fed. Why would a dealer want to go to the Fed? Well, it's getting a rate that's cheaper than what the market is demanding. But why would a dealer go to the market and not go to the standing repo facility? It's reputation. That is so key. Word gets around that this bank went to the standing repo facility, and then all of a sudden that bank, their phone calls stop getting answered by their neighbor banks, and the tightness continues to build. I mentioned to our team this morning on the desk at the Bitcoin Layer and to the readers and viewers last week, repo is only interesting to teach, and it's only really possible to teach when there's something happening in repo. And right now we have a situation that we can analyze and I can use to teach you guys how this market works. It's not a crisis, but it's a tightness, and that's what we have to continue to watch. That's why every morning I'm making sure the first place I go is the New York Fed's website on their SOFR page to see what the print was right at 5 a.m. Pacific time. That's how I stay on top of the primary source information. It all filters down through our beautiful macro bond charts, which are available on our dashboard, available exclusively to those TBL pros, thebitcoinlayer.com/subscribe. Thanks for sticking with this global macro update, repo market update specifically, and Bitcoin price coverage. I'm Nick Bhatia. We'll catch you guys next time.